Well, folks, the recession is officially here, but you will not see that coming out of the mainstream media. In fact, everything that you're seeing is really trying to avoid saying the recession is here, despite the fact that we now officially have 2 quarters in a row of a decline in GDP. And the things that the mainstream and the administration are pointing at and saying, hey, we're not in a recession because of these things, well, those are not exactly signs of confidence for the economy. They're actually signs of some trouble ahead. Ready? Let's dive in. Quick shout out to today's sponsor, iTrust Capital. Whether you want to invest in Bitcoin, crypto, gold, or silver with your retirement funds, iTrust Capital is the best place to do this. It's an alternative investment IRA where you can move money from your existing retirement account or open a new retirement account with them to invest in things like gold, silver, Bitcoin, and other cryptocurrencies. They custody all of your assets in a protected way where they're not mixed with company funds like companies like Coinbase do. They're going to keep it separated, so even in the case of trouble with the company, your assets would still belong to you. They wouldn't be able to use those in bankruptcy filings or anything like that. So that's the best place to invest in gold, silver, crypto, Bitcoin with your retirement funds. And if you sign up with my link in the description below, you'll get $100 worth of Bitcoin bonus in your account for signing up. All right, take a look with me at these crazy headlines that we are seeing coming out of mainstream media right now. This one is from CNBC. GDP fell 0.9% in the second quarter, the second straight decline, and a strong recession signal. So again, they're not saying, hey, that means there's a recession here. They're saying, hey, this is a strong recession signal. From Bloomberg, we are seeing this title, the U.S. economy shrinks for a second quarter, fueling recession fears. Again, not admitting the fact that everybody just used to define a recession this way and saying, hey, that means we're in a recession. Bloomberg is saying, well, now that is fueling recession fears. And similarly from Reuters, we are seeing recession lurking as U.S. economy contracts again in the second quarter. So the same exact thing here. They're not saying the recession's here. They're saying, hey, we're seeing signs, we're seeing fears, we're seeing the recession lurking right around the corner instead of just saying, no, it's here. If this had happened any time in the last 50 years, we would have just said, a recession is happening. And so now we are seeing mainstream media go at great lengths to go along with what the current administration is pushing, saying, hey, well, just because we've always defined it this way doesn't mean that that's the technical definition of it, because the NBER, the National Bureau of Economic Research, I believe, they're the ones that officially say, hey, we were in a recession or not. Now, the reason why they're saying they potentially might not label this an actual recession is because of things like consumer spending is growing at its slowest pace, but it's not yet declining. We're seeing business spending declining. And so we are seeing a couple of these indicators that look like the economy is cooling when really these are just other indications of economic weakness. Now, I pointed out in my video yesterday, I believe it was, maybe 2 days ago, about administration redefining what the word recession means. I pointed out that Janet Yellen on national television said, hey, when you're creating 400,000 jobs a month, that's not a recession. So we're going to look at that. Let's take a look at what jobs are doing right now. This is a chart from Bloomberg. This is the update from this week, what jobless claims have been doing. Jobless claims since March of this year have been on the rise. They are now at an 8-month high. And so we saw these jobless claims coming down during 2021, obviously from the peak in 2020, but they are now on the rise again. Since the beginning of this year, back in January and February, most economic indicators have been worsening. And this is the main one that number one is lagging, but number two is going to drive either economic growth or economic decline. So why is that? Well, we have to take a trip back in time to when 2020 hit. When 2020 hit and they started talking about sending stimulus checks out to everybody, a lot of people freaked out and said, no, you're going to cause hyperinflation. You can't just hand money out to people. Now, what most people were focused on was the $1,000 and the checks that people were getting. That was nothing. That was peanuts by itself. What was the real concern was the 10 times plus that amount that was getting handed out to corporations and governments and organizations. That was real money that still entered the economy. And as that money entered the economy, you have to ask, where did that go? Well, that went to bank accounts of organizations, of corporations, and of individuals. It went to their bank accounts. And as that money hit their bank accounts, the corporations, the organizations, those individuals, certain individuals, it then got spent either on assets or goods. And then as that money got spent, it went to somebody else's bank account who got that as an income. And then their income, they then spent on something else, and asset prices blew up. And then at some point, people started to sell those assets. And so all that new money that entered the economy that got spent on things and assets that bid up those prices initially got sold. Those assets were sold. That was a transfer of those dollars into other people's bank accounts that they then spent on other things. And so as that new money worked its way throughout the economy, we saw this big stimulus effect where prices rose, not really economic growth, just prices adjusting higher for the influx of money that hit the economy. Now, as all that started to happen, a lot of analysts looked and said, hey, look, we can't get inflation because of this. We might have a temporary spike in prices, but then prices will come back down. The only way we could get inflation as a result of all of this stimulus is if we get a wage price spiral, if we see jobs and incomes start to accelerate higher. And guess what? That's exactly what we saw. Why is that? Well, number one, because the stimulus provided some of the ability for people to jump ship. They said, hey, I've finally got a little bit of a safety net. I've hated my job for 10 years. I'm finally going to quit and go do something that I want to do more. The other thing was the asset prices going up. People felt richer and they said, hey, I've got a safety net now. I can quit my job that I've been doing for 10 years that I hate and go do something that I want to do more. The third thing was the effect of mortgages. And this is the one thing that I think people ignore the most, but had the most impact on everyday households, is that mortgage rates went so significantly down that everybody and their mother refinanced. And when they refinanced, their expenses went down for the same exact thing, which is another way of saying they had more money freed up for other stuff, which is another way of saying their incomes went up. So mortgage rates going down made people's incomes go up. On top of that, a lot of people who had owned a house for more than a year had equity in their house they were able to pull out by refinancing and cashing out, a cash out refinance. They were able to use that as, again, a cushion, a safety net. They had been in a job they hated for 10 years and it gave them the courage they needed to quit and move on. This sparked a spiral, the Great Resignation, where everybody was saying, as soon as I don't like my job, I'm just going to quit because there's a million job openings, because everybody was doing the same quitting. So we saw this churning of jobs where corporations had to start raising their wages to attract more and more talent so that they stopped losing it. So we did get this wage price spiral where jobs started to shoot up in this extremely tight labor market that was triggered by the stimulus. So maybe the inflation wasn't a direct result of the $1,000 check sent out to people, but when you add up the stimulus plus the corporate welfare that caused the asset prices to go up, plus the mortgage rates that gave people a huge safety net, and that sparked this wage price spiral as people quit their jobs and jump ship to better jobs, you did get sustained income growth that helped keep up that demand to buy those things even though prices were going up. And this is why when we look at this chart from Bloomberg of jobless claims increasing, this is the number one thing to look at in terms of when the economy's inflation will slow down. It's when this wage price spiral slows down. It's when demand destruction is actually the result, simply because people stop having their incomes rise enough to sustain buying the things that they were buying at those higher prices. Now, the danger here is that as we see some of this demand destruction, as we see some economic pain, as we see unemployment start to shoot back up higher, we start to see the government come in and subsidize that. They say, hey, people are losing their jobs, prices are still higher. We're going to give people gas rebates. We're going to give people gas subsidies. We're going to give people food subsidies. We're going to do X, Y, and Z to increase people's incomes for the things that they really need. Then you don't get that demand destruction in those areas. You subsidize that purchasing power, which frees up income to be spent on other things by everybody. And so you allow the inflation to continue because you stop that demand destruction from taking place, even though natural incomes should be going down. So that is a danger, and I would not be surprised at all to see something like that pop up over the next few months as our economy starts to experience more and more and more pain. But in either case, the recession is here, and the kicker here is that markets are reacting very positively to this because in light of the worsening economic data, the Federal Reserve at their latest meeting started to give signals of future easing. They said, hey, we are going to be watching the data and potentially not raising rates as fast anymore if we need to. This is the first time that they've signaled a pullback, a potential pullback in the future from tightening. They said rates are actually getting close to neutral. And I don't know how, if rates are at 2% and inflation is at 9%, that somehow means you're close to neutral. But apparently at the Federal Reserve, that's what it means. Crazy times. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.